What if I told you Wall Street's biggest players are basically high rollers at a casino, except the house is them? You've got billion-dollar chips flying around, secret backroom deals, and enough jargon to make your head spin alpha, beta, leverage. It's like Las Vegas met a physics class and had a baby. Hedge funds pull money from the ultra-rich, then unleash PhD-level math models and insider networks to hunt for outrageous returns. They charge you just for showing up, and then skim your winnings like a Vegas pit boss who never blinks. And when they lose, well, sometimes they get a government lifeline because failing spectacularly is apparently an acceptable hobby. Over the next 8 minutes, we'll uncover why hedge funds feel like legal gambling dens, how they really rake in cash, and why you might already be unknowingly buying them around the blackjack chips. Buckle up, this isn't your grandma's mutual fund. So what exactly is a hedge fund? Picture a private VIP club where the bouncer only lets in accredited investors. Think billionaires, pension funds, and that one friend who claims they made a killing in crypto. Instead of strict rules and public disclosures like mutual funds, hedge funds operate with a velvet rope and minimal oversight. Members pool their capital into a single pot, handing over control to a fund manager who's usually got more letters after their name than a Scrabble set. These managers can buy, sell, short sell, or spin around circles, screaming all in on anything from stocks and bonds to exotic derivatives. The name hedge comes from the original idea of protecting or hedging against market downturns by holding both long and short positions. But over time, that insurance policy morphed into a thrill ride of complex strategies and sky-high stakes. In short, hedge funds are like that secret supper club your millionaire cousin raves about, exclusive, a bit mysterious, and definitely not FDA approved for the faint of heart. Now that we've seen the velvet ropes, let's crash this party's origins. In 1949, a journalist named Alfred Winslow Jones decided that simply buying stocks was too tame. He created what we now call the first modern hedge fund, a clever mix of long positions on stocks he expected to rise and short positions on those he thought would fall, all wrapped in a private partnership structure. Fast forward to the swinging 60s, and hedge funds were the financial world's best kept secret tiny outfits with a handful of clients quietly chasing above market returns. By the 1980s, hedge funds exploded like a Wall Street fireworks show, fueled by Reagan-era deregulation and an obsession with yield. Suddenly everyone wanted in on the action, from corporate raiders to renegade economists. Then came the roaring 2000s hedge funds ballooned. Bragging rights became all about assets under management, and too big to fail whispered through the corridors of power. Of course, the 2008 financial crisis put a pin in that party balloon. Many funds collapsed or got bailed out, proving that even the smartest quants can miscalculate a black swan. Today, hedge funds still reinvent themselves with fancy acronyms and newfangled strategies, but their origin story remains the same, turning hedging against risk into an adrenaline-pumping thrill ride. Fast forward to today, and the house has perfected its hustle. Here is how they pick your pocket. Here is where the house really takes its cut. The infamous 2 and 20 fee structure. You hand over your pile of cash, and the manager charges a 2% management fee every year just for having your money on their dance card. Think of it as a yearly cover charge to enter the club. On top of that, they grab 20% of any profits you make, which sounds reasonable until you do the math. Let's say you've parked $100 million. 2% off the top is $2 million gone before you even ask, what's our strategy? Then, if the fund earns 10% a solid year, they pocket 20% of that $10 million, so another $2 million. You started with $100 million, the fund did well, but you net just $6 million in gains. Meanwhile, the manager walks away with $4 million. It's like tipping your dealer before the cards are even dealt, then giving them half your winnings when you beat the house. And if the fund loses money, you still pay the 2% fee because someone's got to keep the lights on in that high-tech trading bunker. Welcome to gambling, hedge fund edition. But why play fair when you've got a cheat code? Let's raid their strategy playbook. Hedge funds aren't one-trick ponies. They've got a whole stable of strategies designed to wring profits from any market move. First up, long-short equity. Think of it as betting on the hero and the villain simultaneously. They buy stocks they love and short the ones they hate, pocketing the difference whether the market's up, down, or sideways. Next, global macro, where managers place trillion-dollar bets on everything from interest rates to banana futures, because why not? If you ever wondered who decides whether the dollar will rebound, it's these folks armed with economic models and a crystal ball. Then there's arbitrage, the risk-free play. They exploit tiny price differences, buy gold in one market, sell it in another, rinse, repeat. It's like finding free money on the sidewalk and having a PhD in sidewalk science. Lastly, event-driven strategies target corporate shakeups, mergers, spin-offs, earnings surprises. When two companies announce a merger, hedge funds swoop in like vultures, betting on the deal closing or falling apart. Each method sounds different, but they share one goal: turn complex math, fancy algorithms, and insider insights into cold, hard cash. And if you think that's wild, just wait until someone cranks the leverage to 11. Leverage is the financial equivalent of strapping rockets to your roller skates. Leverage means borrowing money to amplify your bets. Imagine you've got $1 million, but you borrow another $9 million to place a $10 million wager. If your trade goes as planned, you're swimming in returns. But if it goes south, you're wiped out faster than you can say margin call. It's like playing Russian roulette with fireworks. Take a real example. A hedge fund uses 10x leverage on a position. A 1% move in their favor becomes 10%, but a 1% move against them is a 10% loss, and suddenly you owe the bank more than you started with. That's why leverage is a double-edged sword, exhilarating on the way up, catastrophic on the way down. Plenty of funds have sung "We Will Rock You" on the way to record profits, only to face "We Are the Champions" at bankruptcy court. In theory, risk management tools and stop-loss orders should prevent disaster. In practice, hedges often find creative ways around them until, well, they can't. Now let's meet the legends who brought dynamite to a poker game, and the cautionary tales of hedge fund glory and doom. First up, George Soros Quantum Fund in 1992. Soros famously broke the Bank of England by shorting the pound, pocketing over $1 billion in a single day. He bet against a currency pegged to artificial rules, and when it crumbled, he walked away laughing all the way to the Swiss bank talk about beating the dealer at his own game. On the flip side, long-term capital management was Wall Street's wunderkind in 1998. It hired Nobel laureates, built models more complex than a space shuttle, and used rocket fuel-grade leverage. Then a handful of Russian defaults triggered a cascade of losses that nearly collapsed the entire financial system. The Fed had to orchestrate a $3.6 billion bailout just to stop the dominoes, because apparently even math geniuses can't predict every black swan. These stories show both sides of the hedge fund coin, massive triumphs that rewrite financial history, and spectacular flameouts that threaten global stability. But for every wolf of Wall Street, there's a dumpster fire. Let's roast some marshmallows. Hedge funds have a knack for drama. Remember 2008? Some funds bet big on mortgage-backed securities and ended up underwater when the housing bubble popped. Instead of letting them sink, governments handed out bailouts because too big to fail also means too big to embarrass. Then there are the insider trading scandals, fund managers cozying up to execs for a whisper of earnings news, only to get cuffed by the SEC. And let's not forget naked shorting, where some hedge funds sold shares they didn't own, hoping to drive prices down legal in some places, shady everywhere else. Critics say these tactics make hedge funds the financial world's equivalent of that friend who wins at beer pong by secretly bouncing the ball off the table. Public outrage flares, regulators tweet stern warnings, and then the cycle resets. Funds tweak their strategies, politicians promise reforms, and investors keep pouring money back in. It's a high-stakes soap opera where the winners get richer, the losers get fines or headlines, and the audience can't look away. If this is all legal, why does it feel like we are getting hustled? So why do we call hedge funds legal gambling? Because at their core, they share all the trappings of a high-stakes casino, huge bets, sophisticated odds, and the potential for life-changing payoffs or catastrophic losses. Instead of spinning a roulette wheel, managers spin algorithms and economic forecasts. Instead of cards, they deal derivatives and swaps. The house edge? Those 2 and 20 fees that rake in billions, win or lose. But it's not pure chance these aren't your average slot machines. Hedge funds use advanced math, insider networks, and privileged access to information. Think of it as counting cards with satellite imagery and leaked memos. Yet, like any gambler, they face uncertainty, market surprise, models fail, and risk spirals out of control. Regulators try to draw lines, no insider trading, risk limits, position disclosures, but the game evolves faster than the rulebook. And when a funds bet goes south, the socialized bailouts make it feel like they're playing with house money. From the outside, it's a complex financial engine. From the inside, it's a thrilling, ruthless gamble wrapped in legal contracts. In the end, whether you call it trading or gambling, the question remains, do those odds really favor you? So should you care about hedge funds if you're not managing billions? Absolutely. First, their innovations often trickle down to you. ETFs, robo-advisors, and quant funds use the same math models, minus the mansion and yacht budget. Understanding how pros hedge risk can help you diversify your portfolio instead of investing in whatever meme coin your friend's Reddit post suggests. Second, their outsized fees highlight the importance of cost. Paying 2% annually can erode gains over decades, so hunt for low-fee options unless you've got insider Bloomberg terminals at home. If you wouldn't mortgage your house to short the pound, don't lever up your 401k to chase market timing. Life's too short for margin calls and bailouts. At the end of the day, hedge funds aren't mystical money machines, they're high-tech gamblers in three-piece suits. And while they'll keep rolling the dice, you can play smart, diversify, mind your fees, and don't confuse legal gambling with guaranteed gains. Now hit that subscribe button, drop a comment about your wildest money bet, and let's keep learning. Thank you for watching.